Hey everyone, Dave Keller here at StockCharts.com. We're going to talk with Dave Landry here in a few moments. A lot to talk about with the bear market apparently alive and well, the NASDAQ down 5%. We'll also answer some of your great questions from the Final Bar mailbag. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. It's going to be a busy one. It's Tuesday, September 13th, and the market distributing right back below levels. It feels like we're just distant memories in the rearview mirror, and all of a sudden coming right back into play. I remember talking in recent days about that 3,900 level, and it felt like, all right, that was that level we tested a while back, and at some point we may get back to it, or it's going to be this week potentially with the big distribution today. So distribution days like this happen, and that is the reality of equity investing. In a day like this, I always encourage people to take a step back, and we'll try to do that together as much as we can. By the way, we have some really good guests. I'm excited to talk to Dave Landry today. He mentioned before we went live, it feels like I only invite him on when the market's really disruptive. He should know that's how valuable he is to the Final Bar, that he's able to come on in these tough days. Tomorrow, by the way, we have Julius DeKempfner from RRG Research, master of sector rotation. And then on Thursday, the 15th, John Kosar from Asbury Research. We'll see what his Asbury 6 models of breadth and sentiment tell us, given all the disruption we've seen this week. Also, we have a pretty big event coming up in about 3 weeks out, ChartCon. Dave Landry and many others will be coming to our Redmond studios here in Redmond, Washington, doing a fantastic job sharing insights and expertise over a 2-day period. You go to StockCharts.com/ChartCon to sign up for that event. Dave will actually be doing a live trading room during the event, watching the markets as they evolve real time, taking your questions in an interactive session. That is just one piece of a fabulous 2-day event that we have scheduled for you. StockCharts.com/ChartCon to sign up for it. Please do it today. And we'll look forward to seeing you virtually for that virtual conference. Let's continue on today's show. We have a lot of charts to review, and we'll get to as many as we can as we deal with this distribution mode. I want to start with a poll, by the way. We asked you recently, and this is good to check in on days like this when your behavioral biases tend to bubble up very, very quickly because you're reacting emotionally to a lot of the red that you see on your monitors. We asked you, which bias deals with the fact that your investment performance looks better and better in the rearview mirror? I actually got you guys. 48% of you said confirmation bias. That's actually not this one. This is actually hindsight bias. And the way I tend to, the example I like to share with people is if you look back at 2020, look at the market peak in February, the market bottom in March of 2020, and then we sort of rallied from there. As that gets further and further in history, your performance over that period will probably be upgraded in your own memory. You will remember calling the top a lot better than you probably did in the heat of the moment. And you will think that you had this perfect trade right at the lows. And it is literally your brain trying to help you feel better about traumatic experiences. That's called hindsight bias. And what I try to tell people is keep a good log of your trades, keep a good log of your ideas, write a blog, even if you don't share it with another human being, capture your own thoughts, date and time stamped, and then look back and have a time where you look back, reflect, and review your thinking and your trading. It's continuing on with our market recap. A lot of red that we'll try to filter through as much as we can. The S&P down 4.3%. We're back below 4,000, bouncing off of 39.20 going into the close, around 39.32 at the end of the day. The NASDAQ down over 5%. The NASDAQ 100 5.5%. A lot of the what I call the phenomena stocks, sort of the former FANG stocks with a couple other tickers thrown in there, down anywhere from 5.5% to 9.5%, with NVIDIA and Meta really feeling some pain, down over 9% today. The VIX, by the way, bouncing higher, back up to 27. I know one of the charts I'll look at with Dave Landry here in a few moments is the VIX. So we'll talk a little bit about volatility and what that might tell us about where we may be headed next. Interest rates, a big part of the story. Obviously, the inflation number coming before the open really disrupting things and making a lot of people question, I think, the likelihood of just a nice soft landing and a nice gentle recovery from where we're at now. All of a sudden, those expectations have a bit of a question mark on them. Long bond yields actually came down through the course of the day and actually finished right about where they started, around 3.5%. 10-year yields around 3.4%. We're now pushing well above that 3.25% that we hit in 2018. Now we're back to retesting the highs from earlier in 2022. Commodities ended up mixed, but it was a choppy sort of day. Gold finished the day down about 1.3%, silver down almost 2%, copper down 2.5%. Finally, cryptocurrencies, big time risk off move. Yesterday, we're looking at the chart of Bitcoin. We're talking about this recovery. We talked about how you need to get above that previous swing high to confirm an uptrend, how important that is to get that follow through. Talk about the opposite reaction, which is what we saw today. Now 20,000, right back into the thinking. We're just above there right now, around 20,300, but down over 9% today. Ether prices down 6% today. Now, these are volatile areas of the market. Obviously, cryptocurrencies, I think the word volatility is certainly the way you should normally think of them, but excessive volatility on a day like today. And it reminds me to take a step back and think about some of those key lines in the sand. What would you see to be convinced that Bitcoin is in a bullish or bearish phase? We're nearing 20,000, which is a big key number to probably focus in on. Let's look at a chart of the S&P 500, just see what today's move means relative to the long-term trend. You know, when I was describing this chart recently, I sort of said it's honestly, it feels like it's in a multi-month sort of transition period, right? If you look at where we're at right now, it's the same place we were in mid-May, right? In early May, really, right? This is when we first sort of came back down to that 3,900 level. We first tested that level the second week in May. From there, we've bounced off of there a number of times. And now, once again, we're gravitating right to what I call that pivot point or a magnet price around 3,900. This was the low last week. This is where we bounced higher. It's a Fibonacci level, right? It's 61.8% of the way back from the June low to the August high when we retested the 200-day moving average. So it makes a ton of sense that we would bounce off of that level. So this bounce that we've seen in the last couple of days leading up until today makes a ton of sense. Now that this is a big distribution, I think once again, 3,900, very important. As long as we hold that, this is a nice sort of higher low and could be, while we're in obviously a choppy phase, could be again a transition from distribution to accumulation. We break 3,900 though, and all of a sudden that looks a lot less convincing as a higher low and looks more just like a brief bounce within a downtrend. And the previous lows come into play, right? Even down to 38, 37, even lower. So play close attention to that Fibonacci level, the lows from last week. I think a lot of people looking to see if that will hold or not. Now, when we're talking about a market like this, we have to talk about breadth. And one of the charts that I will show you here briefly is just very simply the percent of stocks advancing and declining every day. Now, there are a number of different ways you can actually quantify this. We have a couple different measures on StockCharts that I like to review over time. One of them focuses on volume. My friend Walt Deemer, Paul Desmond spent a lot of time thinking more about the volume on advancers and decliners and thinking about it that way. I tend to keep things super, super simple. And so here we're just looking at what percent of the New York Stock Exchange listings closed up or down on the day as a percentage of the total. 92% by our reading. Finished today, lower today. Now, the problem with that is that usually only happens in a bear market phase. You don't get big bombed out down days like that in a bull market phase, right? That's more when you would see 90% up days, when you see large groups of accumulation. So big bit of distribution here right now, which is an interesting development. The last time we had a 90% down day by this one was in mid-June, which is actually the beginning or sort of in the middle of this move lower into the June. Though we had a number of gaps along the way down. We also have to think about just the breadth by cap tiers. This is the cumulative advanced decline lines. Now, these haven't been updated yet for today's close because we had a lot of movement going into the close. Our data team is sort of polishing all this data and making sure we're showing things accurately. But I would be very keenly aware of where these are relative to their 50-day moving average. Given the distribution, I wouldn't be surprised if most of these, if not all of these, are back below the 50-day moving average. And now you have to think about, did they start undercutting the lows that we saw in June? That's the last time these obviously bottomed higher. A couple of them made a lower low into July. A couple of them made a higher low. And that's what you're looking for in a period of distribution, is whether you get some sort of divergences, some sort of indication of buyers coming in. Not necessarily seeing that here today, obviously with a little more distribution. So I think these remain neutral at this point, but could very quickly, if you see further distribution like you saw today, very quickly makes the picture a lot more negative than we've seen so far. Just to wrap up today's movements on a sector basis, energy and utilities, the top performers, but these are both down over 2.5% today. So energy and utilities, which have been two of the strongest relative sectors, actually the only two out of the 11, if I remember right, that are above their 200-day moving average right now. All the other ones are already below their 200-day. And on the bottom of the list today, you have communication services, tech, consumer discretionary, all down over 5%. We just talked yesterday, if I remember right, about the XLY, names like Amazon and Tesla really sort of showing that recovery, showing that strength and the renewed optimism reflected in the increase in prices, giving a lot of that back. Now, again, let's keep it all in focus. None of those, I think, necessarily have broken a key level of support just yet, but we'll finish off our market recap with one that did. One of our 3 and 3 charts yesterday was the chart of Meta. Now, Meta has sort of been left behind June, July, August, while a lot of the other growth areas in the market were recovering. But what we talked about yesterday is sort of this rectangle kind of period, right? This consolidation zone, 180, 185 on the upper end, 155 on the lower end. We just closed below there today. So I think it's all about the remainder of this week. Do we follow through there and get sort of that bearish validation as we break through that range? What I suggested was whichever way Meta breaks, I wouldn't be surprised if the larger market as a whole sort of follows that direction. As of today, it appears to be breaking lower. We'll take a quick break and we'll be back with today's guest, Dave Landry. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you coming our way when there's a crazy day in the markets to help make sense of things. We do our best to try to connect what's happening in the short term today with the bigger picture. And that's one thing I would encourage you on a day like today, where it is very easy to get drawn into the short-termism of the market reaction. Think about the longer-term themes. Think about the longer-term trends. Think about how the long-term signals have evolved based on what you saw today. We're going to bring on Dave Landry here in a few moments. Before we get there, though, a couple quick announcements. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show. And on Friday, we'll do another one. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions, hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. I was talking a little earlier with Linda Raschke. I've been chatting with Larry Williams about their upcoming presentations at ChartCon coming up in early October. Both of them have provided a lot of great content, along with our entire group of fantastic guest hosts and contributors. All of that is available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Dave Landry. Dave's the founder of DaveLandry.com. Dave, I appreciate, as always, you being willing and courageous enough to come on the show on crazy days like this. How are you hanging in? Okay.
Oh, hanging in there. Yeah, I was peeking behind the curtain a few times like the wizard earlier today. But
everyone should know, as we're prepping for the show, we're trying to get the camera lined up. You were drawn. I could see you drawn over to the markets moving off to your left side. So help us make sense of these things. We're starting with the VIX, obviously a big move higher. This is after volatility. It felt like it was starting to lighten up. What does this chart tell you?
Yeah, I was actually showing the VIX. When I thought about the VIX last night, I wasn't thinking about a day like today. The VIX measures the fear, as everyone knows, or your viewers may know, and it's measuring puts and calls, but usually both of those skyrocket, which causes the big jump in the VIX. Now, the moves are asymmetric in the VIX. When the market sells off like today, you get a really big pop higher. And I actually went long the VIX and closed out by the close. And the reason I wanted to show the VIX today was because one thing I've been doing lately is looking at the VIX intraday when it gets really, really stretched, look to play the VIX, and then look to play possibly the indices, or maybe use it to have a little wind at your backs for the ETF trading. And by stretched, I mean 10% or more away from the moving average. Now, you can play UVXY and SVXY. Got to be careful with those. Don't hold them longer term because they're based on futures, and we don't want to go down that rabbit hole today about how complex that is. It's about a 4 derivative by the time you add it all up. So what I would encourage you to do is watch the VIX when it gets a little stretched. It was a little stretched a couple of days ago. I couldn't imagine that we'd have had such a big move, but as you're pointing out there, was stretched right around 10% below the 10-day moving average. Just real quick, I did a lot of systems way back in the day, worked with Larry Connors, and then I did a lot of systems on my own with the VIX, and these are short-term systems. But they print money, absolutely print money, but every now and then they blow up a little bit, and that's just short-term trading. So in more recent times, I've been focusing more on the intraday with the VIX, and when it gets really stretched, just wait for that bounce back in the market, and that can help you your regular trading too. Just to, like I said, put a little wind in your sails, or wind behind you, so to speak.
Now, when we're looking at the chart of the S&P 500, obviously a big move to the downside again. After I feel like the entire character of this chart appeared to evolve. How are you interpreting today's move relative to what we've seen so far?
Well, years ago, I had a system called the 220 EMA breakout system with a 20-day exponential moving average. And somebody who read the articles in Stocks and Commodities, and that was 1995. I'm dating myself, and they called the lows above the moving average or highs below the moving average. They called it daylight, and that's since morphed into Landry light, which is a two-beer story. But anyway, so and the 30 EMA I find very useful. In fact, I've been calling it my little friend, say hello to my little friend. And just watching the Landry light on that can help to keep you on the right side of the market. Now, when it's going back and forth, like between April and May, the market is choppy. One thing you pointed out that I wanted to mention too is the net price change. Forget about all these indicators, forget about the VIX. Where's the market now, and where was it a month ago, a week ago, 3 weeks ago, whatever, and just draw the line sideways. So we have gone sideways quite a bit. But getting back to the Landry light, it's kind of hard to see in the dark chart, but there's a line at 10 and below, and these could be set. This is the ACP plugin, which you can set them to your own liking. But usually 10 days is a pretty good day. So you want to see about 10 days above or below it before a possible trend is emerging. And obviously we had 1 day of Landry light. Now we're back below. We got whacked right back down. And the other thing that's a bit of a bummer is the nice green we had throughout August, nice little trend resuming. We pull back to the moving average, and then it rolled back over, and we have downside Landry light. So mostly downside as of the last few weeks. And by the way, one thing I've been doing lately is sitting on my hands a lot. And I was a little stressed out, worried about my clients, because I keep telling them, it's better to be on the dock drinking beer, wishing you out to sea, than out to sea, wishing you were on the dock. And I've almost sunk a few times, but that's another story altogether. And today is a day where I'm like, okay, I feel good about not taking these mediocre trades and waiting for the database to produce something. And that's at net sideways movement, while a trend follower like me can't find a setup to save his life.
Yeah, it's so funny. I think it's one of the worst things that trading as a verb implies taking action. A lot of times it's being patient, right? And waiting for the right pitch, to use a baseball term.
Yeah, for sure. The fat pitch. And we're more waiters than traders. And there's actually a psychology behind that, which we can't get into today, but we're made to take action. We're made to work. Unless you're a toll taker, you don't get paid to sit on your butt.
Yeah, we only have about 30 seconds left, Dave.
Okay.
I do want to look at your chart of the S&P here. Talk us through this one and what you're seeing.
Okay, this is the TFM 10% system. It's a 10% line off the 50-week closing high, and then it's just a 50-week moving average on a weekly chart. When you get a close below both of those, bad things usually happen or can happen. Every bear market in history has started that way, and it's gotten you out relatively unscathed. And what we're trying to avoid with this system is the Ian McAfee diaper change sort of moments where the market loses half of its value. And my whole point here is that a little market timing, something as simple as this, which is called the trend following moron 10% system, can help keep you on the right side of the market. So I would encourage your viewers to check out this Landry light and things like that to keep them on the right side of the market.
Dave, it's awesome to chat with you. Thanks for putting today's move in a little bit of perspective. Cannot wait to see you in Redmond here, not too far off. So stay safe until then, all right?
Thank you so much.
That's Dave Landry. Dave's the founder of DaveLandry.com. His plugin, by the way, his free plugin on StockCharts ACP, features some of those indicators that he was talking about, including the Landry light, the percent from closing high. I think it's just a great way, very simple way of just illustrating where we're at relative to those extremes. And you can just get a lot from a simple market chiming system, as Dave was trying to describe. By the way, Dave, as I mentioned, will be speaking at our ChartCon event. It's going to be a lot of fun, and hope you can participate in that, along with Dave, myself, and many others. Great take there from Dave Landry. Let's continue on today's show with our final bar mailbag. I feel like after a day like today, our mailbag will be swollen with lots of questions on how to make sense of things, and we welcome them as you're trying to make sense of what's happening in the markets today, as you're trying to trade your own portfolio, as you're trying to apply the lessons of technical analysis. Keep us in mind for questions, and let's get to question number one. Dave, how do I create a dashboard like yours with a panel showing the Dow industry groups? And I think what you're referring to is on our dashboard page. You can customize this, right? So down here, I have this list that I often refer to. I refer to it on the air sometimes, but during the day, as I'm just trying to follow the markets and what's happening, I pay attention to it often. So for example, today, when the markets are just rupturing to the downside, I always like to look here and see which industry groups are performing the best in a down tape. Same thing, and there's a big up move. What's actually struggling to hold up? Because a lot of times those outliers can be interesting data points. Renewable energy equipment ended up being the top performing Dow industry group today. But some of the solar stocks like FSLR, Sunrun, and some of those other that are in there. A lot of those down today, but not nearly as much as the broader markets. It's some interesting setups. So how did I do that? So a couple things you need to do, a couple steps. So number one, you need to be a friend with this little gear art icon in the upper right. You have the ability to add a lot of additional things onto your dashboard. And again, this is something you can do as a StockCharts member. It's one of the great ways you can customize this site. So it's a really good way to make StockCharts a little more relevant to what you're trying to do, the questions you're trying to answer. Chart panels are those two charts that I have below there. What you want to do is make sure you enable the additional chart list panels, because what this then allows you to do is have these guys down here where you can bring in any of your different chart lists. I just bring in two, the Manamana stocks, or the FANG and FANG-like names that I like to follow, and then the Dow industry groups. There's a long version of how you do this. This is literally, I created a couple of years ago a list of all the different Dow industry groups. I imported them from a list and then added the sector components because I like seeing which sector is which. We'll put a link to the show. I'm sure there's a way I can do it on YouTube, and I'm pretty sure on StockCharts TV on demand. So we'll try to add a link in the description for today's episode to give you that list, because I certainly have the ability to share it with you, and you are welcome. You are welcome to it for sure. But make sure you enable your dashboard to have those additional chart lists. And the charts that you can add allow you to actually put key charts that you want to follow right on your dashboard. This allows me to have this one page up all day and just be going up and down and reflecting on some of the key movements that I want to follow. Thanks for that question, by the way. And here's question number two. Would you consider Tesla to be a cup and handle pattern? Let's take a look here. So we talked about Tesla yesterday when we were talking about some of the mega cap names in the XLY. You remember that Amazon is about 25% of the XLY. Tesla's probably another 20%. So those two names are both together about 45% of the weighting. Home Depot's another like 8 or 9% on top of that. So you have a very top heavy sector. And a lot of like the XLK for technology is also very top heavy. You have a couple names that dominate it, like Apple and Microsoft, of course. So is this a cup and handle pattern? I think what you're probably looking at when you're saying cup and handle is this, which would be sort of this as the cup and then this as the little handle. And the short answer is not really. And here's why, right? There are a couple things that are pretty important to form what I would call a cup and handle pattern. And that is you have a significant high and then a rounded bottom and another significant high right around the same level. So if you went from here up around 400, 380, all the way down and then circled all the way back up to that level, so it's literally like an even rim of the cup, then that would be more of a cup and handle pattern. This one's more like a weird tip over on its side, not as ideal. Now, is it an accumulation pattern of some sort? Probably, right, with the higher low. And a lot of stocks are showing that, right? Coming off of the lows in June or July, rallying up to some sort of resistance in August, and now pulling back and making a higher low. So it's starting to do that. But maybe a better example, one of the oil stocks we showed yesterday, I think it was like Hess. Yeah, this may be a better example of a cup and handle pattern. You see how this is like a rally and then a significant high, rounded bottom, a high that's then at a fairly even level, and then the little cup. That is more of an idealized cup and handle pattern. The chart of Tesla, I don't know if I would call it that. You could call it something else, and certainly a higher low that's pretty important. But that's what makes a cup and handle. Literally looks like a cup with a significant level of, or a consistent level of resistance all around the same price point. You don't want a slanted level up or down. Then it's a different pattern most likely. Next question. Do you prefer simple or exponential moving averages and why? Boy, that's an hour-long answer type of question, but I will give you the 1-minute version because we don't have much time left in the show. So both, right? And I find both of them helpful. It's interesting you asked this question when I had Dave Landry on the show. He featured some of his charts. I think it was the 30-bar EMA that he was showing. My market trend model that we talk about usually every Friday is built on exponential moving averages. And I've had a lot of long water cooler debates with our founder, Chip Anderson, and others about the differences between them. Here's what I would tell you. Simple moving averages have value because, in my opinion, because so many people look at them. There are a lot of money managers that know very little about charts, but they look at charts because they feel like it gives them a sense of what's happened. And if they're looking at any moving averages, it's the 50 and 200-day moving averages. And so many of them that I've worked with are familiar with where these levels are that I found it was really helpful. You'd literally think about trading around these moving averages. And the fact that that was so widespread tells me it's important. I like looking at things that I know a lot of other people are looking at. But if you wanted to answer the question of what's the best way to actually quantify a trend and track a trend over time, there is a reason why my way of doing that, which is my market trend model, is built all on exponential averages and not simple averages, because quite simply, they track the trends a little better. They're more weighted to the more current data. The problem with the 50-day moving averages today and 50 days ago are basically equal importance in the moving average. An exponential average actually weights the current data a little more heavy, so it tends to be much more reactive. It tends to track the trends a lot better. And so if I was coming up with a trading system built on moving averages, I would 100% start with exponential averages. That was the 1 to 2 minute answer to that question. We have a lot more info about simple and exponential moving averages and some applications for those. Go to our chart school section if you want to learn more about them and try to answer that question on your own. We need to wrap the show, folks, and go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. I featured in our market recap. There's so many charts we could have gone through. I wish we could have gone through an exhaustive list of measures of price and breadth, but we hit on a couple of them. And one of the things that's an important metric to follow are 90% days, right? 90% up days and 90% down days. We had a question last week, maybe the week before, about Marty Zweig's double 9 indicators. So if you missed that, go back a couple of weeks. And one of my mailbags, we actually had a question on that, and I shared some information on that. That's also built on 90% days. This is when almost all of the stocks in a particular universe close higher or lower. And it tells you about sort of that, like a strong change in breadth or a strong influx of buyers and sellers. The strong influx of selling, in my opinion, on a day like today, certainly shows you that there's a lot of skepticism, particularly about the ability of the Fed to stay on top of inflation. That's reflected on risk assets going much lower, cryptocurrencies going much lower, and I think 3,900 is an important level to watch. But follow these measures of breadth as you go on beyond today, particularly the cumulative advanced decline lines, to see how today's action sort of affected the long-term trends. Chart number 2 is the VIX. I liked Dave Landry's take on volatility and shifts in the VIX. He had some great comments there about looking at them intraday. I'm intrigued to look a little deeper into that on some of the noisier days in the market. We've talked on this show about how the VIX has tended to range between 20 on the lower end, sort of 30, 35 on the upper end. We've had these shaded areas of general support and resistance on our charts for most of 2022. It's remarkable how we've sort of revolved around these levels. We had pulled back. We'd actually had a bit of a drop in volatility over the last week as the market had rallied. It started to feel like we may retest the lows around 20. Today's bounce all of a sudden just confirms once again we're in this choppy no man's land between optimism and pessimism. I would look to see which way the VIX breaks. If it does go higher from here, if you see further distribution, I would be very much focused on 30 plus, because that's where the market has bottomed out so far in 2022. Finally, I talked about the Dow industry groups, and I think that's a great way, having a list like that where you can reflect on which industries, which themes, which types of names, and what sectors are driving the markets higher or lower, and which ones are not agreeing with the overall market, which ones on a day like today are actually holding up okay. The best performing Dow industry group by our reading was the renewable energy equipment. It's things like solar stocks, hydrogen names, and things like that. It's technically part of the technology sector, but sort of like the green energy sort of approach. It's interesting to me, even in a big down tape, how constructive a chart like RUN actually looks. It's always a good time to own good charts. We'll leave it with that quote. Folks, that's a wrap for today. I want to thank Dave Landry joining us from Louisiana. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.